Hello everybody, this is Toni Turner and welcome to the market now as of about 11 a.m. Eastern on Friday, October the 10th. Before we get started, I want to say that our hearts and prayers are with all of those on the east coast of Florida, Georgia, South Carolina, and North Carolina. All of those folks that have been and will be battered by Hurricane Matthew. We're thinking about you. Our prayers are with you. God bless. And now, on to the market. Wall Street is lower today after a weaker than expected September jobs report indicated that the U.S. Federal Reserve would be cautious about raising interest rates. The Labor Department jobs report showed that U.S. employment growth slowed for the third straight month in September, with employers adding just 156,000 jobs. The rate of unemployment climbed to 5% from 4.9% in August, though the increase was driven by Americans rejoining the labor force. After the report, traders cut the odds of a November rate increase to 10% from 15.5%. However, the CME Group's FedWatch tool showed a 66% chance of an interest rate move in December. And on that news, we'll go on to look at three charts that could give us some insight into the week to come. First of all, as we usually do, we're going to look at our daily chart of the S&P 500, symbol SPY. This is the exchange-traded fund that closely follows our benchmark S&P 500 index. Now, when I captured this chart this morning, the SPY was trading at $215.30 or about $21.53 on the S&P 500 itself. Now, we know that it made an all-time closing high right back up here in August, on August the 15th at $219.50. Since then, though, it consolidated through July, rose a little bit and consolidated through August, then fell down on Fed president's reports that they thought that the interest rate should be lowered or stayed the same. And then, of course, when the Fed finally did meet, they did not raise interest rates, so the S&P bounced up here more toward the middle of September. Since then, and before that, it's been creating a really interesting triangle on its daily chart. You don't usually see formations that last this long before breaking out or breaking down. But then you don't usually see little tiny flags or consolidations that last as long as the prior ones have as well. So this is an odd kind of pattern for the market, but it is what it is, and of course we deal with it. You can see that the 50-day moving average, the green line, is coming over the top of this triangle or consolidation. Now, we could call it a bearish triangle because it's fallen down from this top consolidation. However, not really yet because the market's still in an uptrend. You see a longer term trend line here with the blue line that I've drawn. So we're in a wait and see mode here, more unusual than any pattern I've seen in a long, long time. Now, what we're seeing here is the bears are selling and pushing the market down. The bulls are buying enough to push the market up. So we have a real pressure cooker in here. At some point, for whatever reason, the SPY could hop back over the 50-day moving average and move back up over this 218 line, head back up to 218 and 219. Of course, that would be very bullish. And since November, December, and January are typically the best months in the market, it could happen. It could happen. Or it could break down below this triangular potential support here, move down to below 214 where this line comes in, or about 2140 on the S&P 500 itself, it could of course break down. If it did that, it would probably go down to about 208, which is prior support. We do have support here at 212 where this line comes in. If it breaks down another leg, it would be 208. That would be a 5% drawdown for the market. And then, of course, we have more support at 210, and then 208 is down here. Excuse me for making that mistake. So there it all is. We've got plenty of potential support here. It just depends on what comes in, what catalyst makes this market go higher, which of course could be earnings, good earnings coming in, or whatever makes it go lower. We have, of course, we're looking at not only the most volatile elections season in history. The British pound endured a flash crash early this morning. We are heading into third quarter earnings season when Alcoa Aluminum announces this Monday, October the 10th, after the closing bell, and the market continues to worry again that the Fed will raise interest rates. So there is a lot going on in the month of October, and we are just waiting to see which way the SPI will go. That will help us make further decisions. Now we're looking at the PowerShares QQQ, symbol QQQ. This is the ETF that closely follows our NASDAQ 100 index. The QQQ has done a really good job here of staying above its 50-day moving average and its 20-day moving average. When I captured the chart this morning, it was trading at $118.55. Resistance is up here at 119. In fact, our recent relative high was on September 22nd with a close of $119.09. Now the 50-day moving average comes in here at $117.13. So that should provide some support in here. Our September low down here was $113.63. So it does have support all the way down. And then, of course, we know the all-time high for the Qs was $120.50 back in March of 2000. So it's got a little ways to go here to get back up to the all-time high, but not very far at all. And we have to see here if tech stocks, which have been so very, very strong this year, can continue to go higher on the backs of Amazon is certainly one of them, Google, Amazon, and a recent spurt up in Netflix. So keep an eye on the Qs. If it starts to roll over, then these strong tech stocks, if they lose momentum, that could definitely influence the broader market to take some moves lower. If not, if it moves higher, that can definitely support the broader market and urge it to move higher as well. So we're in a waiting mode with this too. Now we can go on and look at our final chart for the day, the SPDR S&P Retail ETF, symbol XRT. I did go through, as I always do, about 50 sector and industry group charts looking for opportunities for us. I have to say that all of the charts I looked at today, none of them were very attractive setups. The one I found to be the most attractive was the XRT, again the SPDR S&P Retail ETF. Now, when I captured this chart, it was trading at $44.06. The top components in the XRT are Cabela's, which you know was bought this week by Bass Pro Shop. Also Lithium Motors, Dillard's, Amazon, Netflix, Nordstrom, Tiffany's, and our August high was up here at 46.36. If you look back to 2015, you'll see that the XRT was trading at 51, so it's been a lot higher. A lot of our retail stocks have taken a hit in the last year. Now, however, with the Christmas and holiday season approaching, and many retailers that have taken a hit this year are now trading at lower valuations, which makes them more attractive to institutions, I believe this is an industry group that we can keep an eye on. If it falls below $43.23, which would be where the 200-day moving average is, and falls below and heads down below this support at 43, then I am no longer interested in the XRT. However, if the S&P 500 can move higher next week, if the XRT can climb above its 50-day moving average, which comes in right now at about $44.40, if it can climb above it and stay above it for 3 days, that will make it much more attractive to me. And we want 3 closes above the 50-day moving average. And this is all of the time. If we're watching a stock we want to get into that has overhead resistance with the 50-day moving average, a stock or an exchange-traded fund or whatever asset you're trading, if it has resistance overhead of the 50-day moving average, 1 close above this line is usually not enough to confirm that the asset is in an upward move. You need at least 3 closes, in my opinion, to confirm that the asset has strength over the 50-day moving average. Because I've seen stocks many times in ETFs pop above it and then fall back down and retrace their prior move. So if, again, the XRT climbs above it, if the S&P 500 is moving higher, then I may possibly look to the XRT for a move, maybe back up into 46. Okay, now we'll go on to next week's economic reports. But first, please join us this coming Monday online from 4:30 to 6 p.m. Eastern for our next session of Tony's Market Club. We'll talk about which side of the market to trade, have a mini trading lesson, and I'll give you stocks and ETFs that may become ripe for high potential trades. This is a low-priced, high-value opportunity to learn more about the market, become a better trader, and make more money. So please join us. For those who cannot attend our live session, no problem. The recording of our session is available to all of our members just a couple of minutes after the session ends. And now for the coming week's economic reports. We always have a week every month that have light economic reports, and this coming week would be that week. On Monday and Tuesday, not much going on economic report-wise. Wednesday we have our usual crude inventories, and in the afternoon we have our FOMC minutes, and that report can move markets. Thursday, we have our usual weekly jobless claims and our usual weekly natural gas inventories. On Friday, we have our PPI, which is the Producer Price Index, retail sales, and Michigan sentiment. Please do remember to join us for Tony's Market Club this coming Monday. Don't miss out on this fantastic opportunity to raise your trading knowledge and your trading profits. Until next week, keep green on your screen. I'm Toni Turner, and this is The Market Now.